It doesn't matter if you've got a small stack of letters from the IRS on the counter or a big stack of letters from the IRS on the counter. 2026 is going to be a lot tougher because of all these new tax law changes. If you owe back taxes to the IRS or you've got unfiled returns with the IRS. Most people look at this new tax law and say, oh, great, higher standard deduction, lower tax brackets. What could be better? This is the best. Well, if you owe the IRS back taxes, not exactly. In fact, these changes could actually make things way worse. And let me tell you why. I'm not just talking about generic tax planning things that might go wrong. I'm talking about specific steps that the IRS is going to go through to make your life a lot more difficult as a result of these new tax law changes. So if you want a lower tax debt, maybe a lower monthly payment, you want to have the IRS give you a shot at making an offer in compromise. These next 12 months mean a whole lot more to you than the last 5 years combined. I'm Josh Webskowski, and I don't find tax problems find me, and I help fix them every day. I've been doing it for the last 22 years, and I'm here to help you understand the 5 things that you need to do in the next couple of months so that you can save yourself from severe pain, and I mean financial pain, with the IRS having aggressive collections actions coming after you. And in those 22 years that I've been doing taxes, I found that there's 2 distinct groups of people. There are people who act fast in the beginning, right after the federal tax law changes happen, and the people who wait and see if things are going to change. And I'll tell you, the people that act fast are the ones that are miles ahead when it starts getting tougher. People that act fast win, and it's that simple. So there's 5 things you can do. Let's get started. First one, and this is foundational. This is more important than all of the other ones combined. That's before 2026. Get current. File the most recent 6 years of tax returns. ChatGPT doesn't really like it, but it's called Revenue Procedure 5-133. You're not going to find it on ChatGPT. They're going to give it a different name. But it essentially says, if you file the most recent 6 years of returns, you're considered current. That's the first thing you need to do, because they're going to look at you and say, well, you have future earnings. We can collect from that. And so the amount, if you qualify for a payment plan after 2026, it's going to be a higher amount because you're earning more and because it's just the way it works. Now, maybe you're one of those people, and I get it all the time. Maybe you're going to come up to me and say, hey, Josh, what if filing these taxes actually makes things worse? Let me give you a scenario. Scenario number 1, you don't file your taxes and you owe more taxes because the IRS files a substitute for a return. You didn't win. Scenario number 2, you file your taxes. That tax liability is contained and you know exactly what it is. Yes, interest and penalties go on to it. It's going to go either way. They're going to get interest and penalties. However, you've gotten that tax return taken care of and it's out of the question. Now you can move forward and deal with the IRS in one of the other ways, that instead of paying all of the tax that you owe, or let's say it, what the IRS says you owe them. Okay? That's the honest to goodness truth. The IRS says you owe them this much, right? We have a better chance of getting that number down lower if you file your taxes on your time versus allowing the IRS to file it for you, or waiting to see if maybe filing is going to make things worse. So file your taxes. You're going to win, okay? That's the first thing. So let me give you an example. I got a client. He comes in. He hasn't filed for 7 years. You only have to file the last 6 years to be considered current. So he did that. He owed over $167,000 worth of tax debt. What did we do? Filed those tax returns. The IRS says that if it's a paper filed return, it's going to take them up to 16 weeks. Let me translate that for you. That means 6 months. So the IRS gets it into their system after 6 months. Now there's a tax liability on the IRS system. Now we were able to deal with the IRS in terms of, we're not going to pay the entire amount. This guy's dirt broke poor. Let's get him currently not collectible. We got my client down to currently not collectible. So yes, on the record, the IRS keeps on adding interest on top of that tax debt of $167,000. However, they're not checking his financials year after year. And after 10 years, because of the collection statute expiration date, all of that tax debt, $167,000, falls off a cliff and ceases to exist. That's a win for my client. That's what it takes. If you file your taxes on time, you could get her currently not collectible. Let's talk about another client. Her name, well, we won't say it. She owed something like $57,000. Now, normally I like to help people out when it's over $50,000 because realistically, under $50,000, the IRS has got plenty of programs to help you out to make this easier for you. But this is over $50,000. It was $57,000. Her aunt came with her for $1,200. She satisfied that tax debt. Now, what did she do? She put in her application for $200. The application fee was $170 at that time. So she applied for the offer in compromise. She made her first payment. Over the next 5 months, she made additional payments. Voila, $57,000 worth of tax debt gone after 6 months. All it had to do with was filing her taxes on time and then waiting till the IRS got them into their system and then filing for an offer in compromise, or in my other client's case, currently not collectible. You could also apply for a loan. We'll deal with that in a little bit. Let's get on to the second reason why you need to act before 2026, before the IRS measures and algorithms change for calculating how much you can afford to pay in a payment plan. The second thing you gotta really take care of is know your balance due. The IRS has got this algorithm, and every day they add 8%, it's compounded daily, to your tax debt. Now, it's not actually 8%, it's 8% compounded daily, which equals something closer to 13%. So when you look at your tax debt, you want to know what the actual amount, that's including penalties, that's including interest, because just like putting together bread and the flour and the yeast and the egg, that is bread. You can't take anything out of it. It's bread. It's just like tax. Taxes, penalties, interest, it all bakes in. It's one thing. It's called tax. You want to know your actual amount. Now, on my website, I have a questionnaire. People set up an appointment. They click in their phone number, their email address, so they get reminders to be able to show up. It could be a Zoom appointment, it could be in person. This was a Zoom. And this guy put, how much do you think your tax debt is? He put $20,000, I think. When he came into his appointment, we found it was $83,000. Hello, penalties and interest. So get to know the amount that you owe the IRS. It sets a level playing field. Then you know where your starting point is and where your ending point is. And is it realistic that you can get into a payment plan and pay that over the collection statute expiration date, which is 10 years from the due date of the return and the date the return was filed. And 10 years, it falls off a cliff. In that collection statute expiration date period, the IRS can collect tax debt from you. And if you get into a payment plan and you only have so much to pay, and by the end you haven't paid them all the money that they said you owe them, you win. It's just like an offer in compromise. So get to know the amount that you owe to the IRS. That's the first step after you get all of your taxes filed. Let's move on to the third thing that you need to do in 2026 to get ahead of the IRS and their new game and their new algorithms at calculating how much money you can afford to pay them. Okay, let's deal with move number 3. And this is really a sleeper case nobody's really talking about, but the idea is to get into a payment plan or an offer in compromise before 2026 happens. Okay, you do it, you lock in these lower rates. 2026 happens, they're going to have all new algorithms for calculating the amount that you can afford to pay back, and you're going to have higher payments. So lock in a payment agreement now rather than waiting till 2026. You want to look at this in terms of this is 2025, so a lot of people that might qualify this year for a payment plan won't qualify in 2026. People who get qualified today for lower payment plans might be blown out of the water in 2026. So apply for an offer in compromise or a payment plan today. The sooner the better. Now, as long as we're talking about an offer in compromise or settling, the settlement program with the IRS depends on 4 key factors: your income, your expenses, your asset base, and your future earning potential. And with waiting for 2026 to come, they're going to see your future earning potential go up. Have you seen inflation happening? Do you think that inflation isn't affecting the algorithms that the IRS is using to calculate how much they think you're going to be able to pay back because your earnings are going to go up just like everybody else's? Have you heard about the possibility of a stimulus plan? I'm not trying to get political here. I'm just talking about cash flow. If the IRS sees future cash flow, they want it, and they think you don't need it because you haven't paid your taxes for how many years? So they're going to get more aggressive. So the idea is act now while the iron is still hot before all these changes happen in 2026. Now, I started this video with all those fancy letters from the IRS. We know them in the tax community with their number at the top right corner, CP 504, CP 11, 1058 letter. But you're going to know the IRS letter based on the language it uses. And I'll summarize. If you receive anything that says, "We intend to seize your property," or "We intend to levy your property," or "We may garnish your wages," or "Hey folks, we just filed a tax return on your behalf. We just filed a tax return for you," that's called a substitute for return, shorthand SFR. What does that mean? You better file, because that's like a straw man. You just file a regular tax return, that goes away. But married people, they make you single. You have a lower standard deduction, all your income, no expenses. Not a good place to be. So when I began this video, I threw all those letters out. You don't want to throw any of those letters that the IRS sent you out. They contain valuable information that will help you decipher the best exit strategy from your IRS tax problem. I mentioned in the beginning, most people don't remember the letters at the top of the letters, the code or CP 504 or what that really means, but they remember the language. And the more severe the threat in the IRS letter, the more seriously you should take it. These letters were put together in the 1970s. They keep on revamping them, but it pretty much has the same kind of language in there to make you feel scared to call a tax professional and ask for free advice or what should I do? Because most people look at this and say, what gives? I'm a good person. I just maybe didn't file my taxes. Essentially, you're in trouble if you're getting letters from the IRS. Make sure you hang on to them so you can look into it, see what has to happen. Now, I had a guy come in here and he owed the state a lot of money. And he also owed the IRS a lot of money. Somehow, they started garnishing his wages. And that didn't really affect him because he thought, well, they're just taking the money out to pay my tax debt. Well, they kept on and kept on and kept on garnishing his wages. 25% of his paycheck gone out the window. He contacted me after the second time they scraped some money out of his bank account. So his credit card bills are going up. His available cash flow is just going out the window to pay the IRS. They do that to get your attention, not to harm you. It's like, hey, guess what? We can do this legally to get your tax debt paid. They would prefer that you let them do their job. And what is their job? To make sure that the correct amount of tax is paid. You can do that very easily by setting up a payment plan or qualifying as currently not collectible or qualifying, and this is hard, for an offer in compromise. Let me tell you, in 2023, there were about 30,000 people that applied for an offer in compromise, okay? How many people got approved? 41%. That's not 50-50, so the chances aren't in your favor. But 2024 came around and that 30,000 upticked to 33,000. Now you'd think 33,000, well, 40% got approved, right? No, 21% got approved. About half. What is that a sign of? The IRS being more stringent, or some people taking advantage of people who owe the IRS a lot of money, taking a lot of money saying, we'll get you an offer in compromise. Guaranteed they got their fingers crossed behind their back, because there is no guarantee. It's a lot of paperwork and it's a lot of complicated stuff. I'm not going to apply for an offer in compromise if I don't think that's the best exit strategy possible with you. If you want to give me a call, I'm available for representation. We'll take a look at your stuff. If you owe under $50,000 worth of tax debt, you can sure take care of that on your own. But if you have any questions, give us a call. 763-477-4205. If you want a team behind you, helping you, we have a team of former IRS revenue officers, revenue agents, appellate officers. These are the folks that know the game, know how the system works in the IRS, know how to make it work for you. My name is Josh Webskowski with Best Tax Pro. I hope this has been helpful.